Imagine the entire world as a massive building, and Japan is the foundation that holds this building together. For more than 30 years, that foundation stayed stable, supporting everything above it. The United States, Europe, and emerging markets were all living on top of this structure. But suddenly, without warning, the foundation started to crack and shake. People on the upper floors didn't fully understand what was happening, but they could hear strange and terrifying cracking sounds in the system. What is happening right now is a financial earthquake. A shock worth around $7 trillion is hitting the global financial system. But this earthquake is not coming from Wall Street in New York, and not from the financial districts of London. Its origin is much deeper. It is coming from the foundation itself. That foundation is Japan. A country known for technology, innovation, and stability for decades, Japan was seen as a pillar of global finance. A quiet but powerful support system behind global markets, cheap money, stable policy, and ultra-low interest rates made Japan central to global liquidity. For years, global investors depended on Japan. It was the source of cheap borrowing, the place where money cost almost nothing. This created a global dependency on Japanese liquidity, a system where capital could flow freely across the world. But now we are not talking about a small financial issue, we are talking about the Japanese bond market, a market worth more than $7 trillion. This market is not just a domestic system, it is deeply connected to global finance, and when it moves, the world moves with it. To understand the crisis, we need to understand bonds. A bond is a government bond is simply a loan. You lend money to the government, and they promise to pay it back later with interest. For example, you lend $1,000 today, and receive payments over time, plus the principal later. Bonds are traded in markets. If demand increases, prices go up, and yields go down. If investors sell, prices fall, and yields rise. This inverse relationship is one of the core mechanics of global finance. Yields also reflect trust in governments. For decades, Japan kept interest rates extremely low, even reaching 0% or negative levels. This was done to stimulate spending and fight economic stagnation, but it also created a unique global condition. Cheap money became the foundation of global investing. This situation created one of the most powerful financial strategies in history. The carry trade borrow in Japan at almost zero cost, convert the money into dollars or euros, and invest it in higher-yielding assets. The profit was simply the difference in interest rates. This was not a small strategy. It became a global machine moving trillions of dollars. Hedge funds, banks, pension funds, and insurance companies all participated in this system. Money was flowing out of Japan and into every major financial market in the world. Japan slowly became something unexpected. The world's ATM machine. Cheap money was always available, and global investors treated it like unlimited fuel. This liquidity helped fuel real estate bubbles, stock markets, and global expansion everywhere. Over time, the world became dependent on this cheap money. Everything from startups, to governments, to multinational corporations, was indirectly connected to Japan's ultra-low rates. The system looked stable, but it was actually becoming fragile. After decades of stability, something started to shift. Inflation returned globally, and central banks started raising interest rates. Japan was no longer completely isolated. Pressure was building inside its system. As expectations changed, investors began reacting quickly. Japanese government bonds started losing stability. Prices dropped, and yields started rising faster than expected. For years, Japan was seen as completely safe, but now investors started asking a new question. What if Japan is no longer risk-free? That single question changed everything in the bond market. Once Japanese yields started rising, global markets immediately reacted. US bonds, European bonds, and emerging markets all started moving at the same time. Because everything was connected, one major effect was on the US dollar. Japanese investors started bringing money back home, selling foreign assets in the process. This increased pressure on the dollar and weakened its global strength. The most dangerous part was the unwinding of the carry trade. Trillions of dollars in positions started to close at the same time. Borrowed yen had to be repaid. forcing massive selling across global markets. This is why Japan matters so much. Because it is not just a country. It is a global funding source. When it tightens, the entire world feels the shock. We are now entering a new financial era. An era where money is no longer cheap, but expensive and unstable. Interest rates are rising globally, and liquidity is shrinking. The system that held the world together for decades is now changing.